welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for joining us today. Our show today is brought to you by the Global C5 CCIM Summit. This is a great event. This year it's in Chicago. It's September 16th to 18th, and a lot of deal making, a lot of great speakers, a lot of great events around it. Check it out. Learn more at c5summit.realestate. All right, we're going to talk real estate today. You know, one of the things that is interesting, most everyone in our industry is transaction volume, cap rates, you know, what's going on. It seems like that makes the world go round, right? You can develop if you can sell it, if you can lease it, you can sell it. What are prices doing? We hear some of the headlines that of doom and gloom, and no one's buying office, that sort of thing. Well, let's find out the truth. Please welcome my guest. It's Chad Littell. He's National Director of U.S. Market Analytics with CoStar. Chad, good to see you again.
Great to see you, Michael. Thanks for having me.
Well, thank you. And for you guys who are watching the on video, there's a great picture behind Chad of a bull. There you go. It's a bull market, I think. Those of you on radio or on podcasts, you can't see it, but there's a bull in the background. So let's just hope it's a bull market. All right, Chad?
Absolutely. Absolutely.
Yeah, well, let's talk about, where should we start when we're talking about transaction volume and cap rates? Do we start with volume?
I think we start with transaction volume because that tends to lead pricing, right? And cap rates as a reflection of that. And as I think about transaction volume, I tend to think about it over the course of the cycle. And you develop this kind of concept of inertia as selling begets more selling. And so there's a mental model, if you will, or a series of thoughts that I've taken from a great economist by the name of Lakshman Achuthan with the Economic Cycle Research Institute. And so as he studies cycles more broadly and globally, I've taken some of his concepts and applied them to our industry, commercial real estate. And as I think about transaction volume, I'm asking really three questions. Is after the kind of 2022 and 2023, we saw transaction volume fall pretty sharply. And as we start to see some signs of recovery, what I'm asking myself is the recovery pronounced, meaning it's not just 1-2% growth year over year, but are we actually seeing significant growth? And then asking the question, well, is it pervasive? Is it widespread across property types and across geographies? And then the third question is it persistent? Meaning, are we seeing it repetitively quarter after quarter, or is it just, hey, Q2 had a nice blip and we'll see what happens? So I'll back all the way up and I'll start with the first one, the first P, which is pronounced. Mm-hmm. And as we think about, I'm going to cover predominantly the four major property types, and I'll throw in hospitality every once in a while. But is transaction volume recovery pronounced? So if we think about multifamily as largely being the first in and the first out of a downturn, multifamily transaction volume was up 38% year over year. So that's what I mean by pronounced. It wasn't 2%. It wasn't a big portfolio that traded. When we think about industrial, that was up 27% year over year. Retail up 45% year over year. And you and I were talking a little bit before we jumped on, is that, there's this notion that nobody's buying office. Well, office transaction volume was up 66% year over year. Hospitality up 25%. So that's incredibly encouraging that we keep seeing this, quarter over quarter increase, and it's been happening. And so it's pronounced, meaning we're seeing big double-digit increases. Pervasive across property types. We're seeing it across all price points, and then we're also seeing it across different markets. And so, for example, we think about a market like New York. We want our top markets to lead the way. And so if we look back at, Q2 of 2024, New York did about 20 billion in transaction volume across the five major property types. In Q2 of this year, it did about 32 billion. So going from 20 to 32 is quite significant. And then you start thinking about, okay, are all my major markets leading, like Dallas, Los Angeles, Atlanta, your home market? And the answer is yes. You would see some markets in the Midwest, like a Minneapolis, that's more kind of static right now, did about $5 billion last year. The trailing 12 month as of Q2 did about $5 billion here. So you're not seeing markets in retreat. They're either static or we're seeing this pronounced and pervasive. And so the last P that I'll remind our listeners of is persistent. Was this a one-off in Q2? And so I would say the answer to that is no. The low point in transaction volume was Q1 of 2024. And for those who want to get more specific, I think February of 2024. And so for each quarter after that, we've seen this growth where every year the Q1 is the lowest quarter of the year. We build a little momentum in Q2, Q3, and then we see a big pop in Q4. And if you think about that like a scale on a piano, it's a repeating octave, and then every year following, we'll just see this repeating scale climb an octave higher, higher, higher. And so far in 2025, that's exactly what we see. So pronounced, pervasive, and persistent on transaction volume.
That's interesting, and that's what everyone wants to know or should want to know, right? Is where are we in the cycle and what should we expect moving forward? When you looked at the trends there, did you see anything related to the tariffs when they first got announced?
It's interesting. I think we can probably dig into the data and see some of that. So the tariffs were announced in April. And when you look at the monthly data, April was still very strong, particularly, I think a lot about in commercial real estate data in year over year terms, rate of change terms. And so April 25 over April 24 was very strong. But if you stop and think about the selling cycle, is anything that was closing in April when that announcement was made, a lot of that money was already probably hard. So those buyers were not likely walking away from those deals. But it was May where we actually saw a dip in transaction volume compared to almost flatlined, if you will, compared to May of 24. But then something really interesting happened in June as it came roaring right back. It was particularly office and retail that were down in May, and then in June came screaming back higher to therefore give us a quarter that had a very positive picture compared to 2024.
That's interesting. So what would you expect moving forward for volume, Chad?
I think we're going to continue to see more of the same. So where we would likely see double-digit year-over-year growth, and I think we'll see that over a multi-year period where that mental picture is of that, repeating scale on a keyboard where it just keeps climbing every octave. So I anticipate Q3 volume to outpace Q2, and then I think we'll see a strong Q4 this year. And then for those of our listeners who are keeping score at home, who are tracking this data, don't get alarmed by seeing a Q1 step down. We see that every year. I would keep focused on Q1 to Q1, Q2 to Q2, not necessarily the sequential, if that makes sense. And so I think, a lot of things we're going to see in terms of whether fundamentals or cap rates, et cetera, are going to probably shuffle their feet sideways and do a lot of nothing in the next couple of months and maybe quarter or two. Transaction volume leaks higher from here, I think.
Chad, what do you think about the trends for transaction volume when it's related to interest rates? The Fed just recently met, left it unchanged, but there's a lot of signs that maybe they've got some cuts ahead of us.
Right. It was interesting is if you watch what kind of the markets are saying, the probabilities and kind of indications of at least what the market anticipates or what the market wants, these numbers can swing around pretty wildly. But there was about a 30% probability of a rate cut prior to last week's jobs report. And then that has now gone anywhere between high 80s and low 90s. I think it was sitting at about 91% probability as of this morning. And so when the Fed meets in September, if the market gets that rate cut, that can be stimulative to our industry for a couple of different reasons. One is that short-term borrowing costs can become more attractive in our space. But I think two, what it also does is it influences investor sentiment that if the Fed cuts once, that the possibility of additional rate cuts following also might be more or a higher probability going forward. And so I think sentiment is very important and can sometimes be as important or more important than the nominal level of interest rates. And if the market's perceiving interest rates are moving lower, that can be very stimulative to transaction volume.
Yeah, that's a good point. We just taken out some 8% cap rate, Class A office deal, multi-tenant, and a couple government ones that are very long-term leased. And I talked about 8 cap, and people are like, okay, that sounds pretty good. But then we got a quote on a loan today or yesterday that was sub 6, and so now you got a 200 basis point spread on your leverage. That can make a difference. Yeah? What do you
Very
think,
much so.
Chad? Let's talk about cap rates and pricing. So I like how you study the whole market and you look at the trends and you look at the cycles. That's really cool. And I think it's what's important. What the cap rate is today is okay, but what's the trend? So what do you see trend-wise when you look at this cycle and where we are with cap rates now?
Sure. So as we kind of unpack cap rates, we start thinking about what type of things influence cap rates. There's a whole host of them, and people can list more than I'm about to, but some of the key things, if you think about it, would be where's the risk-free rate, where are credit spreads, you think about what property type are we discussing, what market are we discussing, and then at the asset level, one of the areas that I tend to focus a lot on is what is the probability or likelihood of future NOI growth. So you're thinking about the fundamentals, right? Rent, vacancy, supply and demand and so forth. So all of that kind of goes into that big picture. And so we came off of a period of about 2 years where cap rates were moving very quickly and moved substantially higher across all property types. I think in the immediate term, cap rates have all but kind of put in their highs, or they are either here or upon us, right? And so let me back all the way up, and we'll start with the risk-free rate. So the reality is it's been pretty noisy over the last couple of years, but if you look at a 2-year chart, we've been between 4 and 4.5 for the majority of that time, sometimes a little higher, sometimes a little lower. And so likely that's going to stay in that same range. It's about 4.25 today. What we're in, the current environment we're in right now, from an economic standpoint, is kind of slow growth. And so when you think about the Treasury yields, what drives that is not just inflation or not just GDP, but it's really it's inflation, GDP, and policy. And so we're in a period of slow economic growth, which is kind of holding yields in their place. I think a lot of folks might be surprised by the next inflation report or two that'll be more muted than expected and could potentially leak higher in the back half of this year. And then, government policy in terms of, Fed cutting the short end or their policy rate. And so the risk-free rate has kind of been where it's been and could potentially move lower from here, right? So that's a tailwind for cap rates. We think about credit spreads. If you look at something like the BBB OAS is, that spread is incredibly tight right now. You'd have to go back into maybe the mid-90s, the mid-2000s, and then the 2017, 2018 period where you've seen spreads as tight as they are today. And so when those are typically under 150, 200, that is time periods where you see cap rate stability or even cap rate compression. So that's looking at risk-free rate and credit spreads. Depending on your listeners' market and property type preference, like we can't change that, those are what they are. But then as we think about future NOI growth, now we can think about, specific property types and how they move through the cycles. And so multifamily is usually the first in and the first out of an economic correction. And part of the reason for that is that you've got 1-year leases and you got a lot of them, and it reacts to changes in the economy in real time. And so it's interesting, starting with multifamily, is that supply is keeping up with demand. So those are in lockstep. Vacancy has already peaked and is starting to move sideways and lower. And what we're seeing in multifamily cap rates is actually compression, particularly in the really good assets in your top markets. So the first property type we want to watch has already seen cap rates stabilize and are starting to move lower. So it's kind of tied to rent growth, right? So we're starting to see multifamily rent growth tick up, cap rates are moving down. The other kind of 3 of the 4 major property types are telling a little bit different story. And so I'll start with kind of the, what's been the darling asset class of the last number of years is industrial surprisingly posted negative net absorption, and that's a national number in the second quarter. And so pricing power is kind of moving away from owners for the time being. And so we've got rent growth that's sitting at about 1% today for industrial. And to give you a comparison, pre-pandemic, that was chugging along at 5-6% rent growth. Hit the pandemic, and then that moved up to 10% rent growth, settled down to about 1%. But then we're looking at, call it 2-3% by 2027, and then kind of returning back to that 5% maybe by 2028. So the peak in industrial cap rates we think is still near, but it might not yet have happened like as we have seen in multifamily. So we might not see peak industrial cap rates until early 2026, but we want to see rent growth and pricing power return to landlords before we have that conviction and we start to see meaningful compression in that asset class. Office will be likely the latest of all property types to see cap rate compression. We think cap rates for office are largely in and are going to move sideways for the next year plus. We're at all-time high vacancy rates and there's really no pricing power, but that should likely come back, meaning, when I say pricing power, I mean rent growth that's at least at inflation or maybe moving higher. And then with retail, cap rates have largely kind of been moving sideways. We haven't built retail in 15 years for the most part, so we still have vacancy rates that are at close to all-time lows. And despite 2 consecutive quarters of negative net absorption, it hasn't been enough to really move the needle. We're up maybe 25, 50 basis points on vacancy in the retail space. Rent growth there, 1 to 2% currently. And so until those start to get back to that 2, 3, 4% rent growth, I think cap rates just continue to shuffle sideways from here.
Yeah. So when you take it all together, Chad, you take all these property types, you take it nationally, and you look at the cycle, and if you're looking at a cap rate graph, are we at the top overall and starting to come down, or are we kind of level at the top?
Well, across the board, we're pretty level at the top. So we're either at the top or cresting right to that top, in my view. And so multifamily would be the one where I would say, yes, cap rate peaks are in. And then the others were retail kind of moving sideways. So we're already really there. Office, we're likely there. It's really probably industrial that I think is still to come in early 2026.
Yeah. And so talk about timing on the revival of these different sectors. Obviously, you're saying multifamily looks like we're there. We're starting to see some potential cap rate compression, which was nice. I got a very nice Class A apartment complex that folks can call me about. It's about $67 million. It's in a great market. And it's in and that kind of brings me to a question for you. We looked at the CoStar information and the new supply in this market. It's a southeast city, huge supply. And then I see the graph just drops. It's like the fourth quarter, there's no new supply all of a sudden. Is that also an impact on the trends on these cap rates and on the values, right? Because hopefully you would expect some real NOI growth if the market's growing population-wise, right?
Right. We need to. It's a great trend that you brought up, Michael. That new supply, like that new supply spigot, has been shut off in many markets. And so when you think about new starts, for example, across all of the property types we've discussed, for the most part, new starts are at levels we last saw in 2012 to 2014. And so if say for multifamily, for example, absorption is at historically very high rates. And as you continue to decrease new supply, that's going to bring vacancy lower. And so that's going to influence definitely the underwriting and future view of NOI growth and owners having pricing power to take, rent growth back to, 3% and maybe higher. So that will vary market by market. But your point about, construction getting turned off is a very big deal. We're seeing that across the country. Some markets a little more than others. But that's very much weighing in on how investors are underwriting, particularly things like, the lease up and competition and ability to drive rent growth.
Yeah. Well, maybe you can help me with this question for my listeners. I had a question from a client about the office market in a market like Savannah, and not just considering Savannah, but overall market. The vacancy there, according to CoStar, is really low. It's like 3%. And there's no new supply that we can find happening because everybody wants to build hotels there, not office. And he asked me this question, Michael, when will new supply start back again? That's the same question about the apartment market in the southeastern city. No new supply. It's just like no one's building anything. Asked me, well, when new supply? Well, my answer was really intelligent. I said, I have no idea.
I think sometimes that's the best answer.
But then he asked me, well, why is there no new supply? And I'm like, well, look, you've got inflation on supplies. You had sometimes you couldn't get steel, you couldn't get what you needed. Then you had interest rates that just spiked up and stopped starts, and then you have immigration hurting labor, and then you have tariffs scaring lenders, and so it's like it's going on and on, kind of delay. But when I look at my shop, we have about 50 brokers in the Southeast and in every sector. The number one team here is land. So it's like, all right, well, these developers are figuring out they should get started, but when does new supply? Tell me about what you think the impact of the lack of new supply, and I know you're not going to say you have no idea when's new supply start.
Yeah,
that's a broker answer.
It's interesting how you unpacked a lot of different things, and the first thing that came to mind when you asked that question is it's not necessarily it's not an easy answer because it's not just one thing. It's all of it that feeds together. And you did a really, I thought, articulate job of walking through a lot of the different factors. And so it's hard to build new product. It's hard to get financing for new product when vacancies are still pretty close to all-time highs. So, depending on that market, I know you were specific about Savannah where there are low vacancies, but there is somewhat of an aversion from certain lenders to, be exposed to new properties, right? Because many of them are looking at markets regionally or even nationally when they're looking at making different loans, and they see many of these markets, vacancy rates are at or near all-time highs. And although construction starts have fallen off dramatically, what's under construction today is still at elevated levels. I think we need to see another 2 to 4 quarters to go by before you can start to, see that supply pipeline really fall, and then that will put a big downward drag on vacancy rates. And so I think it's hard for, certain lenders to have conviction to go out and build new product when you see these vacancies like this. And, you have 0 to 1% rent growth in some of these markets, depending on the property type. But I think that's changing. And so that will, I think, change in a more dramatic way over the next 2 to 4 quarters.
Yeah, good point. When you look at cap rates and values and NOI growth, and you're looking at, I know you look at the U.S. as a whole, but if you were looking at a market and you saw that there's really no new supply on the books at all, I assume when you're doing projections, and let's look at the U.S. overall, as you mentioned, new supply is down pretty much across the board, right, overall, compared to what we've seen in recent years. How does that impact your thoughts on future values and cap rates and NOI growth?
It's a great question because, if we think about it's a simple formula, but you can take these concepts pretty deep when you just think about values, right? NOI and cap rates. And I think a lot of attention, it should be paid to a simple, essentially the risk-free rate and cap rates. And I think mistakenly, people just want to see that as a one-factor model and assume wherever treasuries go, that's where cap rate grows. And so yes, that is a huge influence on it, but there are periods of the cycle, and that sometimes these periods can last for years, where cap rates and treasury yields are moving in the opposite directions, and that's where you bring in the fundamental side of the conversation is investors' view of future NOI growth. And so as you see a market that is constrained and owners have pricing power, and you can see NOI growth or rent growth start to pick back up at least to pre-COVID levels, and then potentially moving higher if there's no new supply beyond that, then that's absolutely going to weigh on cap rates and bring them lower. Essentially, it's important for listeners to remember and always keep this in mind, is that whenever you hear a cap rate that's quoted, the purest way to think about that is if your future income is going to grow at about the level of long-term inflation. So let's call it kind of 2 to 3%. If you have a situation where NOI growth can now grow different from that, whether downside or upside, say it can grow at 4, 5, 6%, then that cap rate where it's stated is no longer as relevant. And what I mean by that is investors start to switch their mentality of saying, okay, well, if historically I would pay a 5.5 for this income where it's going to grow at 2.5% over the long term, if I think I can get 5% in NOI growth, then I'm fine. I'll pay a high 4 for that going in yield for that future income. And so that's how we start to see this cap rate compression, is when rent growth starts to get above and NOI growth starts to get above inflation.
Yeah, that's a good point. I remember I was a young broker, and I saw a client buying a really low cap for some apartments, and I asked him, look, how do you justify that? He said, Michael, try to build something to compete with this. Try to find the land, see what it's going to cost you to build it. These rents are going to go up.
Right.
Yeah.
And that drives the cap rates lower. And just sometimes using extreme examples helps illustrate the point, is when you think about, go back to 2021 and you think about, nationally, multifamily year-over-year rent growth was at 10 to 12%, and sometimes higher. I mean, Atlanta was even higher than that. Industrial, same thing, double-digit rent growth, and you were seeing deals trade at 3.25, 3.5 cap, and it's because the eye was moved off of the present and into the future of that future NOI growth. So you bring up a great point, is supply constrained markets, you should see cap rate compression.
Yeah. And let's talk about office, circle back to that, because I think that's been the most volatile sector, and really some wild extremes on the difference in the value of replacement cost to compete with it potentially, and what some of these folks are getting these office deals for. We just sold one in the $60 a foot range. We got another one in the $60 a foot range, and we're closing another one about to come on the market. And these things would cost, I don't know, if you were lucky, 10 times that to build it.
Right.
So I guess that's another factor that some of these folks are taking into account, right?
Right. My general view on office, and I spent a lot of time in the office sector throughout my career in commercial real estate, is it's being broadly painted with a negative view that nobody's buying it. Values are way down, and they are for sure, broadly and in certain categories. But to give you an example, if we just look at transaction volume for office in the second quarter, it was about $25 billion. And so for anyone who keeps track of this stuff, that was for deals that were recorded inside the quarter. So that number will go up as we continue. It's just the nature of data collection. After the quarter, we get more data in. But just to do apples to apples comparison, $25 billion in office traded, but then look at, say, retail, it was $28 billion, industrial $28 billion. That's not a huge difference, and that the numbers are different than the headlines. The headlines would make you think that maybe $1 billion traded, that nothing's trading,
Right.
but somebody's buying. $25 billion is a lot in a single quarter, and so where you see prices that are a lot more stable, occupancies that are a lot more stable, and you actually see owners have pricing power, meaning rent growth, is in your smaller office assets and your medical office assets, office that's under 10 million. Where you start to see, some of these distressed deals where, things are trading at $50, $60 a square foot, largely these are going to be your, CBD assets, your older assets, incredibly large assets, that just they're very challenged, right? And so they're trading at $50, $60 a square foot. To your point, replacement might be $700, $800 a square foot on some of those. And so the owners need to come in and have a multi-year business plan where they're, not only doing TIs that fit today's standards, but they need to reimagine the common area space and how people use office. And those are really the stories of that $50, $60 a square foot range. Is these are yesterday's office buildings or even 20, 30 years ago office buildings. But I think many people, if they were to go out and bid on office today, would be very surprised at how much pricing has held up in certain pockets of the country and in certain profiles of office.
Yeah, good point. Well, Chad, what would you leave our audience with to think about as far as transaction volume and cap rates now or moving forward?
I would say that watch the data, don't watch the headlines. The data is telling us in transaction volume that we are seeing persistent growth across all property types and across most regions. That tends to lead prices and drive prices higher as more competition is there. And I think that despite the next maybe quarter or several months of sideways kind of economic movement, I think that late this year and into next year, we should see the economy pick up more swiftly, which will help drive demand and improve fundamentals. And so I would look to the future, 3-4 quarters out, and I think we'll see a much more optimistic picture.
Good. Well, I'm over here doing the Snoopy dance. If you remember the Snoopy dog dance, there we go. I like it. Chad, thanks for joining us today. Appreciate the information.
Pleasure to be with you. Thank you.
All right. Thank you. If you'd like more information from CoStar, check them out at CoStar.com. And if you like any information of value on an office property that you're buying or selling, or you're the lender on it, let me know. I focus on office building sales. And hey, thanks for sharing the show. Please connect with us on your favorite social media. And until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. By the 2025 C5 Plus CCIM Global Summit, the premier commercial real estate conference for networking, deal making, and investment. For more information, visit c5summit.realestate. For more podcasts and videos, subscribe and visit creshow.com.